4 different decades, 4 different triggers, but the exact same mechanism underneath. And here's what nobody's telling you. We're in the setup phase right now. The U.S. national debt just crossed $36 trillion. That's $106,000 per citizen. Interest payments alone hit $1.1 trillion in 2024. That's more than we spend on defense. The Federal Reserve's balance sheet sits at $7.2 trillion, up from $900 billion in 2008. These aren't random numbers, they're warning signs. Because throughout history, when empires accumulate this much debt, they don't pay it back. They can't. The math doesn't work. Instead, they use a different playbook, a hidden mechanism that transfers wealth from the many to the few. It's happened in Rome, Weimar Germany, modern Argentina, Venezuela, and yes, the United States, twice in the last century alone. Let me show you exactly how this pattern works, the specific steps, the warning signs, and who profits when it happens. Because right now, in 2024, we're watching the same setup play out, the same policies, the same rhetoric, the same mathematical impossibility building toward the same inevitable conclusion. You're not crazy for feeling like something's wrong with the economy. Something is wrong, and it's not an accident. This is happening right now, and most people won't see it coming until it's too late. To understand why this pattern is so dangerous, start with what money actually is. Most people think money has intrinsic value. Here's the reality. Modern money is debt. Every dollar is created when someone borrows. When the government borrows, the Federal Reserve creates new money. When you take a mortgage, banks create new money. The entire system runs on one principle: perpetual expansion. More debt equals more money. More money equals economic growth. Growth requires more debt. It's a loop. But here's the problem. Debt must be repaid with interest. If $100 is borrowed at 5% interest, $105 must be repaid. But only $100 exists in the system. Where does the extra $5 come from? More borrowing, more money creation. This works perfectly until it doesn't. Let me show you the moment it breaks. When debt grows faster than the economy can support it, 3 options exist. Option 1, default. Admit the debt can't be repaid. Let banks fail. Let governments collapse. This happened to Lehman Brothers in 2008. The government chose not to let it spread. Option 2, austerity. Cut spending dramatically. Raise taxes. Pay down debt slowly. Greece tried this from 2010 to 2018. GDP fell 26%. Unemployment hit 27%. It was economic suicide. Option 3, devaluation. Print massive amounts of new money. The debt gets repaid, but the currency loses value. Savers get destroyed, but the system survives. Governments always choose option 3. Here's a specific example. In 1933, the U.S. held 195 million ounces of gold. The dollar was defined as 1/20th of an ounce. That's $20.67 per ounce. The government owed $22 billion in 1933 dollars. President Roosevelt revalued gold to $35 per ounce. Overnight, the government's gold was worth 69% more in dollar terms. The debt burden dropped by 41% in real terms. Savers who held dollars lost 41% of their purchasing power. Nobody voted on it. It was Executive Order 6102, signed the 5th of April, 1933. This is the pattern. Accumulate debt during good times, print money during bad times, transfer wealth from savers to debtors. The biggest debtor is always the government, and right now, the U.S. government is the largest debtor in human history. This has happened before. Let me show you. The 15th of August, 1971. President Nixon appeared on television. He announced the United States would no longer convert dollars to gold. The Bretton Woods system ended. The dollar became pure fiat currency. Here's the setup. The Vietnam War cost $168 billion. Social programs expanded under the Great Society. Government spending exploded, but tax revenue couldn't keep up, so they printed money. Foreign governments noticed. France sent warships to New York in 1965 to exchange dollars for gold. By 1971, the U.S. held 8,000 100 tons of gold, but owed 40,000 tons worth of dollars to foreign central banks. The math was impossible, so Nixon changed the rules. Here's what happened next. From August 1971 to December 1974, gold rose from $35 to $195 per ounce. That's a 457% increase. The dollar lost 82% of its value against gold. Oil prices quadrupled. Gas lines formed. Inflation hit 11% in 1974. Workers saw wages buy less every year. The middle class got crushed. But bondholders? They got destroyed. A $10,000 government bond from 1971 lost 82% of its purchasing power by 1974. 3 years, 82% gone. Who won? Anyone who held real assets, gold, real estate, commodities, companies that owned physical things. Who lost? Savers, pensioners, anyone on a fixed income, anyone who believed the dollar was safe. The mechanism was simple. Create more dollars to pay off old debts. The debt gets serviced, but every existing dollar loses value. It's invisible theft, legal theft, systematic theft. Now here's the key. The same pattern is repeating. The government owes $36 trillion. Interest payments consume $1.1 trillion per year. Tax revenue was $4.9 trillion in 2024. That means 22% of all tax revenue goes to interest. This is unsustainable. And when something can't continue, it won't. The question isn't if they'll devalue. The question is when and how fast. Here's what's happening right now. Evidence 1. The Federal Reserve's reverse repo facility. On the 31st of December 2022, the reverse repo facility held $2.55 trillion. By November 2024, it dropped to $234 billion. That's $2.3 trillion that flowed out of safe Fed accounts into the financial system in less than 2 years. What does this mean? Money is leaving safety. It's searching for returns. This happens right before inflation accelerates, because that money will chase goods, services, and assets. Evidence 2. Bank Term Funding Program. March 2023, Silicon Valley Bank collapsed, Signature Bank collapsed, First Republic teetered. The Fed created the Bank Term Funding Program. They lent $163 billion to banks at par value for assets worth far less. Translation: they printed money to save the system. Again, this is textbook pre-devaluation behavior. Protect the banks first. Savers pay later. Evidence 3. Treasury buybacks. May 2024. The U.S. Treasury announced it would begin buying back its own bonds. For the first time since 2000, they're buying $30 billion per quarter. Why would a debtor buy back their own debt? Only one reason: to control interest rates, to prevent yields from spiking. Because if rates spike, the government can't afford the interest payments. This is yield curve control by another name. Japan did this starting in 2016. Their currency lost 40% of its value from 2020 to 2022. Evidence 4. Record gold purchases by central banks. Central banks bought 1,037 tons of gold in 2023. That's the second highest annual purchase on record. China added 225 tons. Poland added 130 tons. Singapore added 77 tons. Why are central banks buying gold? Because they know they're preparing for dollar devaluation. They're moving out of treasury bonds and into hard assets. The People's Bank of China held 1,948 tons in January 2023. By November 2024, they held 2,264 tons. That's a 16% increase in less than 2 years. Evidence 5. The BRICS currency discussion. October 2024. The BRICS summit in Kazan, Russia. Leaders from Brazil, Russia, India, China, and South Africa discussed alternatives to the dollar for trade settlement. Saudi Arabia was invited to join. This isn't conspiracy. This is policy. These nations represent 45% of global population, 36% of global GDP at purchasing power parity. If they reduce dollar usage by even 20%, demand for dollars falls. When demand falls, value falls. Each piece of evidence tells the same story. The system is preparing for a monetary reset. Central banks are hedging. Governments are controlling yields. Money is leaving safety. The pattern is forming. Here's exactly how this works. Let's say you're the U.S. government. You owe $36 trillion. Interest rates are 5%. That's $1.8 trillion in annual interest. But you only collect $4.9 trillion in taxes. And you spend $6.8 trillion per year. The math. Revenue of $4.9 trillion minus spending of $6.8 trillion equals a deficit of $1.9 trillion. You need to borrow $1.9 trillion just to pay this year's bills. But who lends $1.9 trillion? Foreign governments are reducing treasury holdings. China dropped from $1.3 trillion in 2013 to $760 billion in 2024. Japan is stuck at $1.1 trillion. So the Federal Reserve steps in. They don't call it printing money anymore. They call it quantitative easing or providing liquidity. But the mechanism is identical. When the Fed buys treasury bonds, they create new money. This money enters the banking system. Banks hold it as reserves, then they lend it out. Each loan creates more money through fractional reserve banking. Here's the cascade. $1 trillion in Fed purchases becomes $10 trillion in new money supply through the banking multiplier. This money chases limited goods, prices rise. This is inflation. Now, when inflation runs at 7% per year, your $100,000 in savings loses $7,000 in purchasing power annually. In 10 years, that $100,000 buys what $48,000 buys today. You lost 52% without selling a thing. But the government's $36 trillion debt? It also loses 52% in real terms. The debt burden gets cut in half, paid for by everyone holding dollars. This is the hidden tax, the inflation tax. It's invisible, it's regressive, and it's already happening. From January 2020 to December 2023, M2 money supply increased from $15.4 trillion to $21 trillion. That's 36% more dollars in 3 years. Your purchasing power fell accordingly. Who wins and who loses? Winners. 1. The federal government. They owe $36 trillion. Inflation cuts the real value of this debt. At 5% inflation, the debt loses half its value in 14 years. They win by owing money. 2. Large corporations. They borrow cheaply and own real assets. Apple holds $162 billion in cash but also owns factories, intellectual property, and brand value. When dollars lose value, their assets appreciate. 3. Real estate investors. Anyone with a fixed-rate mortgage wins. You borrow in today's dollars, repay in tomorrow's cheaper dollars. A $500,000 mortgage at 3% gets easier to pay every year. Inflation runs at 5%. 4. Commodity producers, oil companies, mining companies, agricultural conglomerates. They own things people need. When currency devalues, commodity prices rise. Exxon and Chevron profit from $100 oil while consumers suffer. 5. The financial sector. Banks borrow at 0% from the Fed during crises. They lend at 5%. The spread is guaranteed profit. JP Morgan's net income hit $49.6 billion in 2023, record profits during a crisis. Losers. 1. Wage earners. Your salary increases 3% per year. Inflation runs at 7%. You lost 4% of purchasing power. In 2020, median household income was $67,521. In 2023, adjusted for inflation, it was worth $61,000. You lost 10% in 3 years. 2. Retirees on fixed pensions. A $3,000 monthly pension loses $210 per month to 7% inflation. That's $2,520 per year. In 10 years, that pension buys what $1,500 buys today. Half your purchasing power, gone. 3. Small savers. You have $50,000 in a savings account earning 0.5% interest. Inflation runs at 5%. you lose 4.5% per year. In 10 years, your $50,000 buys what $31,000 buys today. 4. Bondholders. Government bonds and corporate bonds pay fixed interest. A 10-year treasury paying 3% loses money when inflation runs at 5%. You're guaranteed to lose 2% per year in real terms. 5. Renters. Rent increases track inflation. Your landlord's mortgage stays fixed. They win, you lose. Average rent in the U.S. increased from $1,164 in 2019 to $1,987 in 2024. That's 71% in 5 years. 6. Import-dependent consumers. When the dollar devalues, imported goods cost more. Electronics from China, coffee from Colombia, oil from Saudi Arabia. All prices rise. Your paycheck buys less of everything. You lost 17% of your purchasing power from 2020 to 2024. That's measured by CPI. Real inflation? Probably higher. Food is up 28%. Energy is up 38%. Housing is up 47%. The pattern is clear. Debtors win. Savers lose. Asset owners win. Wage earners lose. Section 7. Action steps. Here's what you need to do now. First, reduce exposure to dollar-denominated assets. Move 10-20% of liquid savings into gold, not gold ETFs, physical gold. Coins or small bars. Store them yourself or in allocated storage where you own specific bars. Gold hit $2,100 per ounce in December 2024. It will likely reach $3,000 within 2 years as dollar devaluation accelerates. This isn't speculation, it's pattern recognition. Second, own real assets that produce income. Real estate with positive cash flow, dividend-paying stocks in companies that own physical assets, farmland, timberland, energy infrastructure, target a 5 to 7% yield minimum. This provides income that adjusts with inflation. A rental property collecting $2,000 per month today will collect $2,600 per month when inflation runs at 5% for 5 years. Third, eliminate variable rate debt and lock in fixed rate debt. If you have student loans at variable rates, refinance to fixed. If you're considering a home purchase, a 30-year fixed mortgage at 7% is your friend when inflation runs higher. You borrow in today's dollars. You repay in tomorrow's cheaper dollars. The bank loses. You win. Fourth, increase skills that generate income in any environment. The best inflation hedge is earning power. Learn skills that can't be automated or outsourced. Sales, specialized technical skills, management, healthcare. Your goal, increase your income faster than inflation erodes it. Negotiate raises. Change jobs if necessary. Wage growth of 8% beats inflation of 5%. Fifth, build cash flow, not just net worth. Net worth on paper means nothing if it's locked in illiquid assets or subject to market crashes. Focus on assets that generate monthly income. Dividends, rent, royalties, interest from short-term bonds. Target $500, $1,000 per month in passive income within 2 years. This cushions against job loss and provides options during crises. These aren't predictions, they're preparations. The pattern is clear, the mechanism is known, the outcome is predictable. Position yourself now, before the next phase begins. The United States government owes $36 trillion. They're paying $1.1 trillion per year in interest. This is mathematically unsustainable. They will devalue. The only question is timing. Every major crisis follows the same pattern. Accumulate debt, print money, devalue currency, transfer wealth from savers to debtors. 1,933, 1,971, 2008, 2020. And next, the choice is yours. You can pretend everything is fine. You can trust that experts will fix it. You can believe this time is different. Or you can recognize the pattern. Position yourself accordingly. And protect what you've built. Join Economy Rewind Premium for weekly breakdowns of exactly what's happening in real time. Market analysis, policy changes, action steps, everything you need to stay ahead of this crisis. Share this video with someone who needs to see it. Most people are sleepwalking into the next devaluation. You can help wake them up. Links to resources, recommended reading, and specific action steps are in the description below. The setup phase is ending. The acceleration phase is beginning. Position yourself now. This is not financial advice. Do your own research. Verify everything I've shown you, but do it quickly, because the pattern never fails, and we're right on schedule.